Hello everyone, welcome to this edition of the Planning Pulse. My name's Andy Ruzicka, I'm the Director of Operations, and today we're going to be talking about IRMAA. We're going to talk about what IRMAA is, we're going to be talking about why it's important for you to know what IRMAA is, and then we're also going to be talking about how we can avoid IRMAA. Most people are very familiar with Uncle Sam, but what a lot of people didn't realize is that about 18 years ago, Uncle Sam got married. And so now there's an Aunt IRMAA, and IRMAA came about in 2007. Essentially what IRMAA is a different set of income brackets that are looked at that determine how much you're going to pay in premiums for Medicare. So while every April you're used to writing that check to Uncle Sam, Aunt IRMAA's getting some money too for a lot of you, but that comes out of your Social Security checks each month as part of your Medicare premiums. So here's a table that shows what those potential extra premiums could be based on your income tax brackets. And it can be a significant number. You can see at the highest bracket for joint or individuals, you're paying more than $500 a month more for Part B and Part D. It impacts both of those plans within Medicare. So what are some of the reasons people end up being subject to IRMAA? One of the biggest ones is being on Medicare while you're still working. With a lot of executives, your stock incentive plan payouts. So maybe you're retired, but you still have stock options. You still are getting restricted stock units that are vesting or performance share units that are vesting. Sometimes those can pump your income up into those higher IRMAA brackets. Deferred compensation plans is another big source of income that occurs after retirement that can impact IRMAA. From portfolio management, capital gains, either from portfolio gains, as I mentioned, sale of your business or sale of a piece of property. Those kind of bigger one-time capital gain moments can definitely impact IRMAA brackets as well. Another big one that comes along for everybody is required minimum distributions. So that's the amount in your traditional IRAs. The IRS starts making you take a portion of that out when you hit a certain age. For most of you, it's probably 73 or 75. So forcing that additional income upon you could put you in IRMAA brackets. And lastly is annuity payouts, especially with non-qualified annuities. Any of the growth in a non-qualified annuity is considered ordinary income as you take those distributions. So that can put you in a higher income and IRMAA bracket. So why is it important to pay attention to IRMAA? Well, as I mentioned, it can be a significant amount of money on a monthly basis. And if you don't account for that when you're trying to project your retirement cash flow, it can really be a kind of a sneaky killer for your retirement plan. We put an example on the screen that shows the retirement plan where on the left side, the plan looks really solid, kind of spend assets down slowly through the whole plan and still end up with a nice chunk of money to leave to your heirs. Well, on the right side, now you're accounting for IRMAA. Perhaps this client had a bigger pension, and when those RMDs kicked in on top of the pension and Social Security and other portfolio income, it put them into a high IRMAA bracket. And in that scenario, they were paying IRMAA for the full period of their life, and that was a $4 million difference over the course of their plan. So significantly impaired the plan. So it's important because you need to be aware of it, and you need to see if it is going to have an impact on your long-term retirement plan. And if it is, then you need to plan for that. Fortunately, there's also ways that you can reduce your exposure to IRMAA. And we're going to kind of walk through what those different paths are based on which source of income is actually putting you in those higher IRMAA brackets. The first thing that we talked about was being on Medicare while still working. So for W-2 employees, the two biggest things you can do is continue to, if you're not already, definitely max out your pre-tax retirement plan contributions. So that's not just necessarily maxing out your 401k, because now 401ks have pre-tax and Roth option. So for your situation, it could make sense to make sure that you're not funding the Roth option, that you're actually doing the pre-tax option if you're subject to IRMAA. The other thing to utilize is maximizing HSA contributions. Now, that's a tricky one because when you're on Medicare, you're not eligible for HSA. So that would really be for a spouse that is not on Medicare yet. You have a younger spouse who qualifies for an HSA plan. Maxing out those contributions can reduce your adjusted gross income, which is what IRMAA is based off of. For business owners, two options above are still great, but in addition to that, you can do bigger profit sharing or maximize your profit sharing contributions, which will reduce your overall income. You can start a cash balance plan. That's a huge way to reduce your taxable income. And then just make sure you're utilizing, bonus depreciation, Section 179 expensing, some of those things that the tax code allows for, and hopefully with a updated tax code coming this year, those might look even more attractive. But those are some ways that business owners can reduce their income that they're showing. Again, bringing that AGI down to hopefully reduce your IRMAA impact or potentially even eliminate it. For those that have these stock incentive plans, restricted stock and performance shares, those have their fixed vesting schedule, and upon vesting, that's a taxable event. So there's not a lot you can do with those as far as reducing the tax impact of those happening because you don't have control of when you have to realize that taxes. Stock options are a different scenario though. When the stock options vest, that's not the taxable event. You actually exercising your stock option is the taxable event. And so strategizing around when you exercise those options and how many options you exercise can have a big impact on if you have to pay IRMAA or not, or how much IRMAA you may be subject to. Another big one is deferred compensation plans. So people that are utilizing deferred compensation plans while working, sometimes the second election gets neglected, and that's the election. You make an election of how much you want to put into the plan each fall during benefits season. There's another election that's typically made, which is how you want to have those assets paid out to you. And most plans default to lump sum, which honestly doesn't do you a whole lot of good. And so most of the time with clients, what we do is strategize around how many years we should be spreading those payments out to reduce your income tax impact and also reduce your IRMAA impact. That's the big one with deferred compensation plans. For capital gains, certainly, having a process where you're constantly looking at tax loss harvesting is a big way to help reduce the impact of capital gains. Some places will look at the end of the year as part of their tax planning. Some places, will only look, when the market is down. But honestly, any market environment, there could be opportunity for tax loss harvesting. So it's something that you should always have your pulse on, as not every asset class is always performing well all the time. So their tax loss harvesting opportunities is a big way to help reduce capital gain impact. There's also some capital gain deferral strategies out there. So with real estate, you can do 1031 exchanges, could be a good option. There's also been the ability to do opportunity zones in the past, which is a deferral of any capital gain. That one's not necessarily a great option right now, but again, hopefully with some updated tax laws getting passed this year, they'll bring back the ability to do the opportunity zones again, which would be amazing. For required minimum distributions, the way to reduce the impact of required minimum distributions on your income is to look at strategies where you perform Roth conversions between the time that you retire and the time that you hit your required minimum distribution age. And so that's something that we will frequently do with clients. Another way to reduce the impact of required minimum distributions is utilizing qualified charitable distributions, or QCDs. That is when you take, instead of you writing a check out of your checkbook to whatever your favorite charity is or church, you send the money directly from your IRA. And that counts towards meeting your required minimum distribution, but then it's also not taxable. So instead of, if you write a $5,000 check, you may be able to take that as an itemized deduction within your, if you itemize deductions, as a charitable contribution. But if you send $5,000 from your IRA to the charitable entity, you're for sure reducing your taxable income, and it's above the line, so it reduces your AGI, which is what IRMAA is based off of, AGI. And finally, annuity payouts. So there's not a lot you can do with annuity payouts, but one strategy is to explore what the annuitization options are. And there's other risks that are tied to that, so everything really needs to be explored with that. But when you annuitize a contract, it does lessen the upfront impact of those distributions, because you end up with a pro rata amount of the distribution being taxable, and some of it ends up being, return of capital and tax-free to you. So those are all options as far as reducing the impact of all these different sources of income that can drive IRMAA. And so while, IRMAA may not be well known, it's definitely something that needs to be focused on, because it can be a silent killer to your retirement plan. And it's something that at PWM, we do a lot of planning around. And so thankfully, there are a lot of different options to reduce that impact, but everything's going to look different based on your situation. So if this is something that you have interest in exploring, then please reach out to us. We'd be happy to analyze potential IRMAA impact on your situation. If it looks like it could be a factor, then we can help you reduce that impact, or in a lot of cases completely eliminate it based on different strategies. So that's IRMAA in a nutshell. So really appreciate you joining us today. And as always, if we can help you with anything IRMAA or any other planning wise, please don't hesitate to reach out. Take care.